Hello, and thank you for joining us today as we look to share AMP Capital's understanding of the coronavirus situation worldwide. I'm Katerina Torian, Senior Editor here at AMP Capital and your host for today's webinar. I'll shortly be joined by Shane Oliver, who is our Chief Economist. I've always been struck by Shane's ability to, as he says, turn down the noise. That attitude creates clarity about the true nature and magnitude of a human and market event. As the coronavirus, or COVID-19, grips markets and rattles confidence, we need to remember some basic truths behind the panic. First and foremost, this is a human health emergency and one we should all rally behind. Further, though this is a live and challenging event for markets, it too shall pass, just as rattles and crashes have before. Holding your nerve is crucial when you understand that basic truth. In saying that, investment professionals are charged with assessing and reacting to market events, and they do so in intense detail and with conviction. For insight on how AMP Capital understands and is monitoring this situation, as well as a look at the impacts and outlooks on key global markets, I'll now hand over to Shane Oliver.
Thank you, Katerina, and thanks for joining us today. It's certainly a rather a hectic day, not a good one for investors, obviously not a good one for health professionals and others being affected by this virus. As Katerina said, it is first and foremost a human disaster, but obviously we do worry about our investments. I certainly worry about mine. I also have an elderly mother who worries about her investments, and the sad thing for her is she had to cancel a cruise, which she was about to head off on tomorrow. So it's a rather difficult time for many of us. What I thought I'd do is run through how markets are being affected by coronavirus, what it might mean, and also end off on some basic principles of investing that I've learned, I guess, over the last 36 years of being in or around markets. I guess the first question is how much have markets come down? It's bouncing around quite a bit, but as of the low early this morning, the US market was down about 26-27%. That's the S&P 500. Australian markets down about 30% from its high, and I'm talking about the high just over 3 weeks ago. And it's similar amounts in Japan. In Europe, the Eurozone market is down about 34% from its high. The Chinese share market, I didn't mention there because it's actually bounced from its low. It had that fall early into February, but it's recovered a chunk of that, albeit it's still volatile. But maybe the Chinese share market tells us something, because once the number of new cases on a daily basis peaked and started to decline, the Chinese share market managed to rally after a roughly 12% fall. So the next slide shows, if I can get it to move, maybe it's not moving right now, but it soon will be. Shows the disclaimer, which you should read, but in essence, I'm not a financial planner here. I'm providing information which is shown there, but if you do want specific advice, it is advisable to get a financial plan or see a financial planner and get more specific advice. So what have markets done? That chart there gives you a rough guide. I just put that up there to provide some perspective. This was updated a few days ago when the market was down about 12 or 13%. Since then, as I mentioned, we're down a lot more than that. So it has been a steep fall. We haven't seen falls on this magnitude since the 2008 period. The reason I've shown that chart is to just put things in perspective. It's the Australian share market and the US share market indexed to 100 in January 2000. You can see the tech wreck. US shares fell roughly 50%, rallied, then another 50% fall at the time of the GFC, only managed to make new highs in 2013. Similarly, our market, great time through the last decade or the 2000s, fell 50-odd% with the GFC and then managed to rally, but lots of grinding around it, only made a new high recently. So again, it took us about 12 years to make a new high, just as it took the US share market 13 years to make a new high after the tech boom peak. So I'm not a great fan of saying, well, markets record highs, therefore they were due to fall. I would say, though, that we did have very strong gains, particularly from August last year, and so we were due a correction. Coronavirus then came along. Initially, it looked like it would be contained to China, so that's why the markets were able to rally again after initially falling into early February and then make new highs at the latter part of February. Since then, it's become clear that the coronavirus is going global. and that I think is what's rattled markets. We're seeing shutdowns on a global basis, Italy, schools in France, New York, and they, I think, will inevitably start to be an issue in Australia. I think there's already some recommendation before the federal government to that effect, with gatherings greater than 500 people. So that will have an economic impact as people don't go to work or don't spend as much, don't go to the cafes, focus on only buying necessities. Now, the other thing that's happened, of course, is a secondary flow-on effect, and this is evident in the oil market. The oil price had fallen quite substantially up until, say, Thursday a week ago. And of course, OPEC then had a meeting with Russia to try and cut production. They couldn't reach agreement. That broke down. And of course, that subsequent fall in the oil prices accentuated the weakness in share markets. Now, that one I find a little bit perverse. If you go back to all major bear markets in the past, or the really big ones that were associated with the recessions, they were preceded by oil price surges, crimping spending, and then ultimately causing a problem. And when the oil price comes down, I actually feel a little bit better off because it's going to cost less to fill up the Holden. But I guess there is a perversity in all of these things. The reason the oil price decline has accentuated the weakness is that there's many oil producers now in the US share market, shale oil producers. There's worries that they will cut investment, and there's worries that they may default on some of their loans. Similar concerns were around in 2016, if you recall. So all of these things are playing out. And then finally, markets have been looking for policymakers for an adequate response in some areas. That's been lacking, not in Australia, but in the US. President Trump got the market G'd up earlier in the week. The market rallied almost 5%, US market did. And of course, he didn't really deliver in an address to the nation yesterday. And of course, overnight, we also saw the European Central Bank, I think, miscommunicate a little bit, imply that they're not too concerned about a blowout in Italy's bond spread relative to Germany. So that, I think, added to the concern that the policy response in some key countries is lacking a little bit. Now, I think they will get their act together, but that will take time before that happens. So if we just move on from this, that's all what's happened. This is how we see things, and this is our base case. Obviously, these things are moving around quite a bit, but we do think global growth will take a hit, at least in the March quarter. It may be the June quarter as well, but we will see a rebound in the second half of the year. The best way to characterise all of this is as a disruption, which I think is very important to a traditional recession. Traditional recession is preceded by significant excess and monetary tightening, and then, of course, economic variables get impacted by that, and of course, you slide into recession. This time around, you haven't really seen that. In some areas there is some vulnerability there in relation to the Australian housing market and corporate debt in the US, but it's due to disruption caused by coronavirus. It's like if I can't get to work because public transport's not working or whatever it is, I have to work at home that particular day because of a storm or whatever. But when the immediate disruption goes away, then you go back to work. Now, providing it's kept to that, then we should see a rebound in the second half of the year, and I'll come on to that in a moment. But I think that's the best way to see it. It is a disruption. There will come a time like China when the number of cases starts to recede, things will return to normal, and then markets presumably will rebound on the back of that. So that is our base case. There's some details there. China will have negative growth this quarter, but it should start to see some pickup in the June quarter and the September quarter. Now, that will be constrained if global growth is still weak. But other countries, Japan, negative technical, already falling into technical recession, I think, or we'll get there. And inflation, we think, will remain low. So you're looking at a situation, I'll detail this one a bit later, but China takes the first hit, then followed by other countries. And that sort of spreads it out through the March and June quarters to some degree, then a rebound in the second half of the year. Inflation remaining pretty low. That, I think, will get a kick lower because of the collapse in oil prices. And that in turn provides plenty of scope for policy stimulus going forward, including in Australia. And I think that stimulus will be quite large. We've already seen a stimulus in Australia of around 1% over the next 12 months of GDP, which is a lot bigger than I would have thought just a few weeks ago. So they've effectively done what I thought they should do, so therefore they get a tick for that. We've also seen the Reserve Bank cut the cash rate. We've also seen the Reserve Bank apparently inject 8.8 billion into the short-term funding market today because of disruptions in that market. So Australian authorities are moving pretty quickly on this front, which I think is commendable, and fingers crossed, it'll limit any downturn in the Australian economy. If I look forward, I think it's way too early to say that shares have bottomed. We are in a sense of panic. There's lots of people nervous out there who may still sell. If I look out 6 or 12 months horizon, I think we will have recovered from this disruption. There may be some aftershocks, but I think markets will rebound to reflect that. Just on the risks, obviously coronavirus is a big one. The other ones I'll leave for the time being, and I won't get into the medium-term thematics. Happy to take questions on them if necessary. Obviously, it is all about coronavirus as per The Economist magazine. I think every cover of The Economist magazine since sometime in the latter part of January has coronavirus mentioned somewhere. So it's obviously the big issue, and it's the headline issue. I heard on one of the radio stations today, I was flipping across, someone said, the big story of this week was coronavirus, and the second big story was the other story on coronavirus. So that's all we hear about these days. I like to put these things into some perspective, which these charts do. It shows what I think is the most important thing to watch, and that is the daily number of new cases, not the total number of cases, but the daily number of new cases. The reason I watch that is in relation to SARS. When that peaked, it saw Asian share markets bottom out in 2003. And more recently, when it seemed to have peaked in China, it contributed to a bottoming out in the Chinese share market. So the good news is that China looks to have had their situation under control. I guess some people might say, well, we don't believe the numbers, whatever, but I don't buy that argument. I think they've done a great story there of making things up. They just told us there was a disaster and then so they've got it under control. It does seem to me like there was a real problem there. So I don't think they made up the rise, and nor do I think they've made up the fall. It's quite common for the Chinese president to not initially go to areas of disaster until there's some sort of control. You wouldn't be seeing President Xi Jinping walking through Wuhan if the situation was still way out of control. So I do think the Chinese numbers are to be believed. It's also worth noting the number of deaths have declined, and the green line there shows the number of recoveries have declined because there's less people left to recover because there's less cases. Now, if you go to the bad news, which is the next chart on the top right, you can see the huge rise in the number of new daily cases outside of China, and that's now far, far exceeded the peak in China. If you exclude that little bit where it goes off the chart, which is when China decided to start reporting people who tested positive clinically. I think the problem with that test was that it includes virtually everybody who suffers from pneumonia, whether they had coronavirus or not. So they then went back to lab tests. But if you look at the lab tests line, which is the red line, excluding that little spike, the number of cases on a daily basis outside China is now well above the peak in China. We've now got more than 120 countries with coronavirus. I think the whole world will probably end up with it. And you can see in the bottom right chart there, rapid rate of growth. Iran seems to be tracking along bit like China did. Korea was a problem a while ago. Korea seems to be doing a better job of getting things under control. You can see their line starting to flatten out a little bit, but other countries are still quite clearly a concern. Look at Norway, Switzerland, Italy still going up, or that may flatten out soon, but still going up quite rapidly. Even Australia's been picking up, and the US, of course, France and Germany concerned. Spain is a concern. So it's way too early to say that we're close to a peak in the number of new cases on a daily basis. A lot of comparisons with 1918. 1918 did show one thing, or a couple of things. One is that measures to lock down, cancel events in cities in the US at the time did slow the spread of the virus and the number of deaths. So there is quite a lot of merit in lockdown, even though it does have economic consequences. Several things to note about 1918, though, is that roughly 50 million people died. A lot of those died from secondary bacterial infections, which should now, in theory at least, be treated with antibiotics. Regular flu in the US kills a lot every year. In 2017-18, 44.8 million people got it. 61,000 died from it, which is a death rate of about 0.1%. For over 65-year-olds, that death rate is close to 1%. If we go down to coronavirus, the currently reported death rate is around 3.5%. I think it's recently edged up a little bit to 3.7%. There is a lot of debate about this, and I don't know the answer. I spoke to one person, they'll have one theory, another person will have another theory, so it's all over the place. I did find the Diamond Princess to be quite insightful, though. There was 370 people of that boat, passengers and crew, all were tested, 705 got the virus, and of those, apparently 1% or 7 died. And that's just possibly a death rate of around 1%. Now, at least 6 of those 7 were over 70. I don't know the age of the last person to die, but that would suggest the death rate may be a bit lower than commonly reported for people over 65 or 70. It may be close to 1%, which is closer to regular flu. Now, you can debate this all over the place. I don't really know the answer to this. Others would say the death rate is a lot higher, and therefore one shouldn't relax. Bottom line is I don't really know the answer to it, but obviously governments are concerned enough to focus more on containment. And they're also concerned that if they don't contain it, then their healthcare systems will be overwhelmed because they won't have enough hospital beds to treat the sick. So there's a whole bunch of issues around that. I should point out, though, that most of the evidence suggests that younger people below 60, and I've got to be worried here a little bit because this year I turned 60, younger people have much lower death rates, and most of them apparently get a cold, in which case you wouldn't even bother to show up to get tested, and therefore you wouldn't be measured in the denominator of the mortality rate, which is another factor that potentially exaggerates the mortality rate. But lots of debate on this. I don't really know the answer to it. I lean to the view that it's perhaps not quite as bad as portrayed, but it's still going to have a significant economic impact. I did take a little bit of comfort from this, that Australia is one of the most well-prepared countries for a pandemic. Then I saw a picture of Donald Trump, I don't think we've got it here, holding the same chart up. That made me a little bit worried, because when I look at the US, I don't think they are as prepared as Australia is for a pandemic. Just look at the number of masks they've got stored away. I think it's well below what Australia has. So that could be a bit of a concern, that countries which think they're well prepared, like the US, maybe turn out not to be as well prepared. Just looking at the global economy, it has taken a hit from this, and that's showing up in business surveys. So if you look at the next chart, the left-hand side chart there shows global GDP growth in red, and the blue line is a global business conditions indicator, commonly called a PMI. You can see it was nicely starting to edge up a little bit going into January of this year, but since then it's fallen sharply. And that's the case for both services and manufacturing. And it's worth noting that the bulk of that fall was due to China, which I've shown in the next chart. The PMI is shown in the top left. You can see it sort of normally tracks around just above 50. And recently it's fallen to levels around, depending on which one you look at, fallen down to around 25 or 30. So it's like the Chinese economy fell off a cliff in February. I don't think that was a surprise to anybody, really. It certainly wasn't a surprise to the Chinese share market when that data came out 2 weeks ago. The reason is that many people like ourselves now track daily data out of China, and you can see there's some indicators. They already showed that. It was already quite clear that when you look at traffic congestion, coal consumption at major power stations, and property transactions, as well as things like steel demand and so on, cargo loadings on trains, all tracking below normal levels for this time of year. So the vertical line there is the Chinese New Year. You normally slow down for a bit because of the Chinese Lunar New Year holiday, then you bounce back. We haven't seen the bounce back. The good news is that Chinese economic indicators are gradually starting to edge higher. All of those lines, particularly coming into March, have started to lift to greater or lesser degrees, not back to normal, but it does suggest that the worst is probably over for China, assuming they've got the virus under control, and they will get some impact from less demand for their exports, but internally it looks as if the worst may be over for China. As I mentioned, though, the problem is the rest of the world, and that's why we're so concerned, and that's why markets have been impacted. The next chart shows US economic data. Up until now, it's still strong. Even the data out this week is still strong from China, from the US. Very low unemployment, confidence levels very high, which is good. But we do know that that data will start to slow down. Now, this is, I think, critically important. It's a fairly detailed table. It shows all US share market falls, top to bottom, since 1968, really, greater than 10%. And you can see there've been a lot of them. And you can also see that the deeper ones, where you come down a certain amount, 20% or so, and then a year later you're down another big notch, like the mid-1970s, 73, 74, particularly like the tech wreck or like the GFC, they tend to be associated with US recessions. Whereas if America avoids a recession, the downswing tends to be milder. Obviously, the 87 crash is an exception to that, and they tend to end faster. Now, at the moment, I think we've got something, just looking at the way markets are moving, which may be comparable to something like the 87 crash in terms of the severity of the fall over a short period. Hopefully it doesn't fall the same amount, but it's getting close to it. And also the GFC. But the GFC was complicated because the inner workings of the US economy were messed up for a while. Hopefully the coronavirus doesn't cause that. Now, if it's the case that the US goes into recession, our base case is in fact that they do go into recession, but it's really a disruption. Then once the source of that disruption, the lockdowns associated with coronavirus, goes away, then the economy should rebound, and I think the share market should reflect that. That's our base case. If I look at US recession indicators, this is quite important. The yield curve went inverted or negative about a year ago, or 6 months or so ago now, then uninverted over Christmas, and now it's inverted again. Well, at least one of those yield curves has, the 10s, 2s hasn't. But that is flashing red. If you look at other indicators on the US, they are not flashing red. America hasn't had the cyclical spending boom that normally precedes a recession. You look at the bottom right chart there. Cyclical spending as a share of US GDP is actually below normal. That's quite important, because if you go into a building, go up to level 1, fall out, you'll probably be okay. You might be hurt a bit, but you'll probably be okay. Go up to level 25, then fall out, well, you're probably stuffed. I don't think the US economy or even the Australian economy ever got anywhere near level 25. So yes, they get hit by the coronavirus, but they probably don't have the same damage that would occur if they had the usual boom that precedes recessions. Just the global economy. So I've shown some scenarios here, a base case, and then sort of call it a recession, although I think the base case itself might morph into a recession. Best to look at the charts, and also best to focus on the pattern rather than the precise levels. Once you focus on the precise levels, you can get lost in the numbers. But our base case was that, or still is, that the global economy gets a hit in the March quarter because of the size of the hit to China. So just think about China. It's had, for 5 or 6 weeks, a shutdown of somewhere around 40% of their economy, could be as high as 50%. Divide 5 or 6 weeks into 13 weeks and multiply it by, say, 0.4, you've got quite a big hit to the Chinese economy in the March quarter. Then we thought, well, okay, once China starts to come back to normal as it goes into April, May, June, or through March into April, May, June, then that would give you an equal rebound coming out of that, which would offset weakness in the US and the rest of the world. So that's our base case, and you can see there, Chinese chart, top right, down, then back up again fairly quickly, offsetting weakness through the June quarter. If you go down the bottom there, the next chart down, in the US. So it's simply because of the size of the Chinese economy and the size of their moves down then up that gives you that pattern where you get hit in the March quarter, then you look a bit healthier after that. Now, the worst case is where China has a slower rebound. It spends 2 quarters going backwards, and the rest of the world also has greater deepness of the downturn through the June and September quarters. You can notice there that the blue line does actually assume a recession in the US in the June and September quarters. So that's quite significant, particularly for Donald Trump, if he lets that happen. But the worst case would be an even deeper recession, and that's a similar story across Europe, say, and Japan. And so therefore the rebound which occurs in China, even in the worst case, is not enough to offset that. So the world economy has a much deeper recession. Now, in both of these scenarios, though, it is worth noting that you get that uptick in through the second half of the year, most notably in the almost certainly through the December quarter. So you can sort of debate whether that's going to happen. I guess, on coronavirus, there's not a lot of evidence that it's about to go away just yet. But I am reasonably confident, and I'm not an epidemiologist here, that as we go into the Northern Hemisphere summer, then that will start to bring it under control to some degree, particularly when combined with all these shutdowns and lockdowns. The evidence suggests from lockdowns that they do help slow the virus, and if we come into warmer weather, then that should also help get it under control. And then hopefully as we go into next year, the threat is removed because a vaccine will come along, or at least antivirals. So that is the key in all of this, whether the base case or the worst case, that there's a rebound out there. Now, the trick, I think, is the policy response and making sure we don't have collateral damage along the way. So the next chart shows the things that you need to look at. I think you need to look at the number of new coronavirus cases on a daily basis. And that was one of the first charts I put up. So not the total number of cases, it'll keep rising for a while, even though the number of new cases slow down. You've got to track the number of new cases. In other words, the second derivative. I'd also look for evidence of antivirals, vaccine, Northern Hemisphere summer starting to bring it under control. My understanding is that antivirals and vaccine is still a way off. Or governments may just say, we're coming into summer now in the Northern Hemisphere, it's going to come under control. We've seen some evidence of that. We'll wind down the lockdowns. Now, the other things I think were very important to look at, obviously for economic activity, you look at the daily activity indicators where they do exist. You can get weekly indicators in the US on confidence, similar in Australia. Auction clearance rates, I think, will be important because quite clearly the property market is at risk of being affected by this in Australia. Unemployment claims in the US, and also those indicators I referred to in relation to China earlier. Business surveys and businesses generally, I think, are very important to monitor. What we really need to see here is that the number of companies that run into trouble through this period is kept to a minimum. That's why it's also very important that you have policy support, which is why I was quite pleased that the federal government came out with that stimulus yesterday, and it was so robust in terms of money being paid, particularly to small and medium-sized enterprises, to keep them going through this period, because it is going to get rough. As soon as we start shutting gatherings down, and then that, if you work in businesses where the number of people coming into work is cut by half, even rotation plans and so on, working from home, then that's going to mean lots of capos and others will suffer a little bit through this period. So if they're given some support to keep their employees on board, maybe some of them might do what happened through the GFC. It's worth going back to the GFC. What happened in Australia, our unemployment rate only got as high as 5.9%. I just checked it on the way coming to this webinar. The reason for that is that a lot of companies switch their employees from full-time to part-time work. Now, of course, part-time is not great if you want full-time, but it's better than being unemployed. So if those things happen, then that I think will help dramatically. That's why it's very important to look at policies. What you also need to see central banks making sure that there's no upset in financing markets. And that's why I like the way the RBA seems to be quite aggressive here. Others are as well, not as aggressive as I would like though. So that's very important to see that action the RBA did today. On the one hand, you could say, well, that's terrible, it's reminiscent of the GFC, but the fact is those sorts of things helped us get through the GFC. If they don't intervene in the funding markets, then banks and organisations will start to run into funding difficulties. So I think that's a good sign. That's the key thing, I think, that gives me confidence the base case will happen, but it's maybe necessary, but it's not sufficient yet. We still need to see those other things happen as well, such as a peak in the number of new coronavirus cases. So if we move on, bottom line is interest rates are going to stay low and probably fall further. It looks like we're all in a bit of a race to zero at the moment. I certainly wasn't expecting this 2 months ago, but coronavirus has changed everything. Mind you, I was forecasting Australian interest rates to fall to 0.25%, so I haven't really changed on that front, but I didn't expect the US would be cutting again like they have been, and I do think the RBA will cut to 0.25% in April, and they will follow that up with some form of quantitative easing. They're currently calling that yield curve control, but I also think that will entail ultimately, anyway, some fairly aggressive bond buying to inject cash into the economy. And the US, there's a good chance that they will take their Fed funds rate down to a range of 0.25% next week. So low interest rates are going to be here for a while to come. My mother is still not happy with that. Although I do point out to her, she's still getting paid her dividends from shares in, I think, Westpac and BHP. So they make up for the lack of interest on her bank deposits. So it's not altogether bad. Just on monetary easing, we have seen significant monetary easing around the world over the last 12 months. And that, I think, does, again, give me some confidence there will be a pickup sometime in the second half of the year. The relevance of all this for President Trump, I think, is quite intense at present. If you had asked me 2 months ago, I would have said there's not going to be a US recession because coronavirus was not a big enough problem and the economy was motoring along quite nicely. That means that President Trump is probably going to get re-elected. That's what history tells us, that presidents get re-elected providing there's no recession prior to the election. One who did was Coolidge back in 1924, but all the others, Bush Senior, Carter, Ford, Hoover and Taft, did not, because they allowed recessions in the period before the election. Now, the thing with President Trump is getting a bit risky at the moment because I think the likelihood is the US will slide into recession through the June and September quarters, and that will be a problem for him. It also comes at a time when he's allowed 30-odd million Americans to go without health insurance. So you've got a potential recession, which is usually bad for presidents, and you've got a big chunk of Americans without health insurance, and those people aren't going to be too happy going into this health crisis. So that could work against Donald Trump. As an investor, putting aside my personal views, that would have been more a concern to me a little while back, to the extent that Sanders might then have walked into the White House. And I'm just talking here as an investor, not giving you my personal views as to who would make the best president. But Sanders has tanked lately, and Biden has risen to the ascendancy and looks like being the candidate of the Democrats. Long way to go yet, and who knows how that ultimately pans out. But if the alternative is Sanders and Trump loses, I think investors might say, okay, well, there's some bad things in that. He might want to raise taxes, corporate tax rate, but at the end of the day, he's fairly pro-business, and they might also argue, well, he's a steady hand. The other thing I guess you could say, times like this, you probably need a drink. I like this chart. I've been using it for years, and I've got an endpoint to it now, a new endpoint. Maybe I think I need the 2 drinks per day, but in times like this, you perhaps need a drink to relax. Many years ago, I did a seminar with this other presenter called Dr. John, and he had this chart. I've drawn it from memory. It basically shows that if you're a teetotaler, you've got a high risk of dying, similar risk of dying to someone who has 6 per day. So you could joke, well, you might as well have 6 per day. The optimal number of drinks is about 2 per day or thereabouts. I think it's slightly less for females. The recommended guideline for drinks per day in Australia was 2 per day. They've recently lowered a little bit, but I haven't got a new comparative chart. So it's just below 2 drinks per day. That's 20 grams of pure ethanol if you want to measure it precisely. I've just worked out that when I run out of that hand sanitizer stuff, I've just got to go and find some ethanol somewhere and pour that over my hands, and that'll cover me. But I don't know where you buy ethanol though. But anyway, although I do put it in the Holden, 10% blend though. The thing is that always struck me about this is the recommended guideline for the US was so high, over 4 standard drinks for females and 5 standard drinks for men, which probably explains their politics. They're all drunk or brain cells have been wiped out. If per charts, this sort of takes us down another track. If per charts Bernie Sanders does end up as president, I'm now totally relaxed, because one of his tweets a few weeks ago was, on the first day of my presidency, we're going to legalise marijuana. So I kind of thought, well, if he becomes president, nothing much will get done. And so share markets don't really need to worry about a Bernie Sanders presidency. So anyway, move on from that. Eurozone, it was okay, but this is all pre the crisis. We haven't got a lot of data since the coronavirus took off. I'm conscious of this magazine cover for Australia from November 2018. Got me worried at the time, got a lot of others worried, because we're all concerned about what they did in relation to Brazil. Brazil taking off, 4 years later, Brazil blew into the mountain, or the Christ the Redeemer did anyway, as Brazil collapsed and had all sorts of problems. So I did get worried that the kangaroo will come collapsing through the cloud. Ever since then, we've been talking about a recession in Australia. I thought we would avoid a recession. Unfortunately, coronavirus may have got the better of that. There are some positives in Australia. The mining investment numbers look to be bottoming out. Housing construction approvals, there's some signs they may be getting close to a low. They've been bouncing around a little bit lately, but the Dow trend may have come to an end, so that may be a positive sign. But retail sales look horrible, and the strength we had been seeing in education and to a lesser degree tourism will come under pressure to some degree or was already coming under pressure as a result of coronavirus impact on China. So if I'm looking at Australia, we had a bit of a pickup occurring in the Aussie economy into or through last year. We got growth back above 2% on an annual basis, but it was only 0.5% in the last quarter. And if you allow for, or if you remove the impact of public spending, trade, and giving money to real estate agents to transact houses, the private sector actually went backwards. Or the economy went backwards. So it wasn't as strong as it first appeared. We will take a hit in the March quarter. Treasury has told us that as well. And that's because of the impact on tourism and education and to a lesser degree commodities. So we're probably already going to see a negative for the March quarter. But we now think it will also mean a negative for the June quarter. And we changed our forecast on the Australian economy last Friday to encompass a recession. So our base case, the light blue line in the bottom right chart, does see recession in Australia. And you can see a downwards revision from our pre-virus assessment, which wasn't that strong in the first place. We only saw growth getting up to about 2.1% through this year. But now things have been messed up by the virus. I should point out that the growth numbers there are quarterly growth at an annual rate, just to show the pattern. If I show the rolling 12-month figure, you won't see the recession, but we do see a recession in the March and June quarters. The reason we now see one is because of the spread of the virus globally, which will impact Australian demand for our exports in the June quarter, and also impact spending in Australia over the next few months as we go into lockdowns, or as it seems likely we go into lockdowns in Australia. I've also shown a worst case there. Again, the point is that once the disruption runs to an end, eventually we will get through the virus, then our growth will rebound. Now, I must admit, in my own mind, I do have a bit of debate, and if you speak to a doctor, they'll tell you this, that the virus could linger longer in Australia because we're only coming into our winter. So there is a risk that it could peak not in the next few months, as I think will happen in the Northern Hemisphere, but in Australia it might linger into August or thereabouts, which would be a concern, which does raise the possibility of the economy going backwards for a third quarter. I don't think so, but it's certainly a risk. Now, we have seen a significant stimulus announced by the federal government yesterday. If you look at the numbers there, it amounts to 2% of GDP just in the June quarter. If you assume most of the spending occurs in the June quarter, I think that does raise the prospect we may avoid a recession, but I think the downside in the very short term is just too great. And I also think that half of that money is going to welfare recipients and others, and they may delay the spending until they're a bit more confident to get out there to the extent that they would have otherwise. So there is some risk that spending, which helps in the next few months, obviously the government has targeted it to avoid a recession. Hopefully that will work, but I fear that it probably won't show up until a big enough way into the second half of the year. But that spending, the Reserve Bank measures, I think do give me confidence we will see that rebound, and that they will also head off secondary effects as businesses and others come under pressure through this period of lockdown that we probably will face. Just 7 reasons why I think there is some support for the Australian economy, why we don't want to get too gloomy on all of this. I'll add an 8th reason. The 8th reason, I noticed yesterday, I was talking to planners in Port Macquarie, Coffs Harbour and Tamworth. And despite what you might read in the paper that I wasn't dispatched earlier in the week, that was arranged 6 months ago. So it's just a lot of the trips I regularly do. Now, one of the things I noticed when I was up there was how green and lush it all was. And I went through a bushfire damaged area. All the trees were black, but coming out of every tree was this really thick growth, aqua colour. It almost looked quite beautiful in a way, and centimetre thick grass covering all over the ground. So the bush is regenerating. I'm thinking if I'd gone through there 2 months ago, I would have been pretty depressed, just as I was here in Sydney. And it just does remind me that these gloomy periods do come to an end. That's what we were worried about 2 months ago, the bushfires, the smoke, the horror of people losing their homes, and then a lot of the damage has been done, but it didn't go on forever. And I think we all have to remember the same will apply in relation to the virus. 7 things, just run through them. That was number 8, but call it 7 here. We are seeing rate cuts that will provide some help. We're seeing tax cuts. I should add into that lower petrol price. Now, I'm going to be filling my car up today, and on the way in, I saw $1.10. If I go back just a few months ago, I'm quite sure I saw $1.73. Maybe Sydney's northern beaches are a bit extravagant, but you know, petrol prices have come down a lot, and that might incline me to buy some twisties or something when I go into the gas station to pay for the bill. But anyway, that's another slight boost. We've got infrastructure spending is booming. We all know that. The low Aussie dollar, it's come down 63 cents now. Started the year with 70 cents. That will provide some help. The drag from falling mining investment is over. The scope for fiscal stimulus if needed. I think we will see more broad-based stimulus come the May budget. Population growth is still strong. And again, if you look at cyclical spending in Australia in that chart there, we never really had the boom. Prior to the early 90s recession, we had a massive spending boom. The champagne was bubbling over the glass, as Paul Keating put it. We haven't really seen that in Australia this time. So the bust or any slowdown we have arguably won't be as deep. I'll just zip over the next chart. Infrastructure. Property market, I think, is vulnerable here. There's no doubt about that. I was thinking prices would be up another 10% or so in Australia this year. I prefer they weren't, to be honest with you, because I think it's grossly nice for people like me, baby boom, but not so good for millennials. But I do think now that coronavirus poses a big risk to that. Chinese buyers obviously been away for a while, hasn't had much impact if you look at the clearance rates. But the more we start talking about this, the more people think, oh, well, I can put this on hold. I won't show up at the auction. I don't want to deal unnecessarily with people at present. So that is a factor. And then if unemployment goes up a little bit, that may also be a factor which really takes the edge off the property market. So there is a bit of a risk here for the property market in the short term from coronavirus, particularly over the next few months. Investment cycle. Just quickly wrapping all this up, what does it mean for investments? You know, one of the big debates is where we are in the cycle. Every time we have one of these setbacks, you know, we start thinking the end is nigh, but we don't get to that traditional end in the cycle where we have a boom, everything goes bust as interest rates rise dramatically. We still haven't got to that point. So I'm still a bit reluctant to say that we're going into a sort of classic end of the cycle just yet. I think this is really a disruption. If I look at share market valuations, they've come down dramatically. The forward PE on Australian shares is now around 13 times. A few weeks ago, it was around 18 times. Similar decline for markets around the world, which have fallen 30-odd%. So valuations have proved in dramatically. And if you do a comparison to bond yields, it's even more dramatic. These charts aren't totally up to date for the last week, unfortunately. This comparison, I think, is still of relevance. If I take my money out of the share market, I will do several things. One is I'll lock in a loss. 2 is I won't be getting any income flow on it. The dividends, I'll probably put it in the cash market, overnight cash, I'll get 0. If I put it in a term deposit for 1 year, lock it up for 1 year, most I'll get is about 1 or 1.5%. So not the best situation there. At some point, investors will say, well, maybe it's not such a bright idea having all that money sitting in cash, and the money, some of that money goes back into the share market. Now, I agree. Some companies will cut their dividends. There's no doubt about that. But if you look at the history of dividends in Australia, they go down by far less than the share market does. In fact, companies tend to smooth their dividends, and you can see that happen at the time of the GFC. The dividend yield actually went up to 9% as opposed to go down. So if we just move on to bond yields, we know record low there. I think everyone knows that one. I'll leave that one. The other issue for investors is this. Obviously, slower economic growth will weigh on commercial property, particularly retail property. Obviously has an impact on some infrastructure assets like airports, but by and large, we still use this property and it's still providing pretty good yields. And therefore, in a world where the 10-year bond yield is 0.7% and you can get a commercial property yield up around 5.5%, then I'd say that's still relatively attractive in this environment. And similar story for infrastructure investments. Aussie dollar, I think, is getting close to the bottom, but as long as there's absence of confidence about when the virus will come under control, I'd have to say it would go lower. The other thing is you can make an argument that if you do have money in shares and it's in international shares and it's still unhedged, you're exposed to foreign currency, then if the Aussie dollar goes down, it provides a bit of a hedge on your investment in shares. because as the Aussie dollar goes down, it improves the foreign currency value of your investment, offsetting the fall in the share market. So maybe there is an argument through this period of uncertainty to maintain unhedged global equities as part of a portfolio. Now, these are my 9 favourite rules for investors to keep in mind in times like the present. I think we all have to make sure we make the most of compound interest. This is why my super got to a level I never thought it would get 3 weeks ago. It's come down now, but if I think back even 10 years ago, 20 years ago, it still got to a level, even today where it is today, it still got to a level that I never imagined it would get to. Now, if I got flipped out of the market every time we had the 87 crash or GFC or Asian crisis or whatever it is, trade wars, then I think I would have ended up with a far smaller portfolio in my superannuation. And it is just worth bearing in mind, it's very important that we don't get thrown off by the cycles, that we try and invest on a long-term basis. There are some people who can trade markets very well, and we try to do that. But I think for most individuals, that is just too difficult. For example, when I put this chart together on the left this morning and the one on the right, the market was down 26% using data from yesterday. We're now down 30%. Now, if someone had sold yesterday, say, for the next couple of days, next couple of months, they might sleep well at night. But odds are at some point there, the markets will come to the view that we've seen the worst, it's factored in, and markets will start looking forward to the recovery. You'll come in here one day and the Dow Jones or the S&P is up 5-6%. You will say that's just a dead cat bounce. A couple of days later, it's up with another 5 or 6%. Before you know it, it's above the level where you sold out. So I think it is dangerous to sort of think you can time the markets and sell at this point in time. If you do sell at this point in time, you are locking in a loss. So back to the rules, try and invest for the long term, try and diversify, almost very important to have a well-diversified portfolio of Australian shares, say, to get that dividend smoothing. If you've just got the one company that happens to cut its dividends, you don't do so well. Very important, I think, to turn down the noise. I'll come back to that. Always very important if you want to maximise your portfolio over time to buy low and sell high. Yeah, not a lot of people were thinking of selling 3 weeks ago, but a lot of people are thinking of selling now. And what's the logic of that? Shares are 30% cheaper than they were back then. So I've never been able to understand the logic of that. And don't forget, I'm not a property speaker. I don't spruiker. I'm not a property spruiker or a share spruiker. I don't work for a real estate agent, nor do I work for an equity stockbroker. I'm just telling this stuff in relation to my own portfolio and what I think works over long periods of time. Beware the crowded extremes. A lot of people piling into bond ETFs at the moment because, gee whiz, they've had a great return over recent years as bond yields have fallen. Just bear in mind that those ETFs are buying bonds or getting exposure to bonds on very, very low yields. And at some point, the music will stop. And we know that it's often when everyone's piling in at the most optimistic point. I don't know when that will be. I do know that bonds can provide a bit of diversification through a fall, but at some point those bond ETFs will stop performing as well as they have. Always make sure when you invest in things you understand. If you don't understand investments, don't be there, and seek advice. Very important for people in this environment, if they're thinking of selling, I think, to get advice. Now, if I just zip through some of those other points there, turn down the noise. Yeah, I think about my mother's life, 87 years old this year. She's seen a lot of things, you know, Great Depression, World War II, they were major events. And I think that we get spooked by a lot of short-term stuff, which really just turns out to be a lot of noise. And it is very important to try and turn that noise down. Recent years, there's been a lot of that. Obviously, coronavirus, bushfires have added to that recently. But if I think about the last 5 years, despite all that noise, the returns from investment markets haven't been too bad. So it is just worth putting that into perspective. And finally, you've got to find some way to turn this stuff off. Sitting around all night watching the news and how many people have got coronavirus and all that sort of stuff is going to be very scary stuff. Unfortunately, The Bachelor's not on at the moment. I did watch it last year and I was quite impressed by it. Although I thought he got with the wrong person. He should have got with her rather than Chelsea. I think they've now split. I think, is that the case? They have split, yeah. I did read that right. Anyway, it'll soon come back, just like share markets eventually. So yes, we are going through a difficult period. That will linger for a while. I do think we will probably have a recession in Australia. I would have thought that wasn't going to be the case, but this will probably just tip us over the edge. I am impressed by the policy moves in Australia. I think they're doing precisely the right thing, and they seem to have moved very quickly to recognise the scale of the problem. I think we do need to see other policymakers around the world, particularly the ECB and the US government get their act together. I think they will. But I think the key in all of this is, I don't know when the markets are going to bottom. They may have bottomed, but I fear that we may go lower from here. But I am reasonably confident we're going to see a bounce back in the second half of the year, and markets will at some point start to anticipate that, and you'll see quite a strong rebound. So I think we've got time for some questions.
Mm-hmm. Thanks, Shane. I would love to talk a bit more about The Bachelor, but unfortunately I'm going to stay on coronavirus for a bit. One of the consistent questions that has come through, and it might seem a bit obvious, but in fact I'd like to know the answer as well. How is this different to any other normal flu season, which impacts tens of thousands? And I know you touched on this sort of right at the beginning of the presentation. What's the difference?
Well, that's a good question. The difference, as portrayed, is that the death rate is a lot higher. It's 3.5%, whereas standard flu is about 0.1%. The problem we face is that the death rate may not be accurately measured at present. When swine flu first came along, the death rate was around 9.5%. I think it was in one of the early charts there. And it eventually fell to something like 0.02% or 0.04%. So it may well be the case that once we actually accurately measure everybody who might have been exposed to it, or in a particular sample, as we saw in the Diamond Princess, the death rate is actually quite a lot lower. But yeah, I don't really know the answer to that. I know there's optimists who say it is similar to common flu. Death rate for older people over 65 or 70 is around 1%. Others say that's not the case. It's much higher than that. I don't really know the answer.
And this is a really big question, but how do you think this compares to the GFC?
Well, in terms of me being feeling nervous about it, I feel as nervous as I did through the GFC. It does remind me of elements of that. We saw days there when the market was down very heavily. I had a holiday in the GFC, went to Samoa, I think it was. And a funny thing is nothing worked out. Well, nothing worked in terms of nothing connected. They had no Gs over there, so my phone wouldn't connect. I got the news a few days later via a newspaper. Anyway, by the time I got back, the share market was off 19% or something. This was at the height of the Lehman crisis or just after that. So obviously we've had a similar week this week. When I last looked at my desk, we were down 20% on our market this week. So yeah, we are seeing something similar in that regard. The only thing I think is different is that I think this is a disruption caused by what you might say is a black swan event, but it's exogenous to the markets or to the economy. It's a virus, and you know, with a little luck, and I think history tells us these things, this will go away. Hopefully it doesn't cause too much damage and death in the process, but and the market will move on, providing there's not too much collateral damage. But the problems with the GFC was that there was significant damage to the global financial system, particularly the US banking system, that had to be worked through, and that made it just that much worse. And therefore it was like a death by 1,000 cuts over a period from October 2007 to March of 2009. It lingered. This seems to be occurring a lot quicker as the news on the virus deteriorates, but it also comes with it the prospect that once things go back to normal, the virus starts to lose its grip globally, then you could see a much stronger rebound, much stronger than we saw from the GFC.
Okay, so to talk about the GFC again, when that occurred, smartphones were only just beginning, so social media was pretty much in its infancy. Do you think information overload has impacted investor reactions this time around, and therefore the market's reactions as well?
I think it probably does. Yeah, I think it probably does. I used to have, I think the problem with social media is that it tends to the alarmist, and regular media then has to compete with that to some degree. So if you subscribe to, as I do, the Herald or the AFR or the Australian or something, if you go on the website, the headlines seem a bit more negative than they used to, and maybe that's pressure from social media. You know, you want the person to click on the story. I've sort of taken to the view that I won't actually read the website version. I will click on, some of the newspapers offer today's paper, and you can read it as a newspaper. And I think when I do that, I get a far more balanced view of things, because I look at the good news stories as well as the bad news. Not that there's a lot of good news stories in the media, but there are some in there. But yeah, I think what's happened with social media, it's pushed media generally into perhaps more of a negative focus than used to be the case. And that could accelerate movements in markets, particularly to the downside. The other thing that might have accelerated the movement to the downside is the growth of algorithmic trading or computerized trading. So the institutions, traditional active managers sort of hang back and think, we don't know how to play this, but you've got these programs which are just sort of trading off momentum, and they may be forcing things down. I mean, that may be wrong, because you can argue things have changed pretty quickly on the coronavirus over the last 3 weeks. So that would have justified a quick response. But I do think that social media may be playing a role in the volatility here, along with computerized trading.
Okay, and sort of speaking of other things that are impacting markets as well, how much of the current situation do you think is really coronavirus related versus some other pretty important factors like oil prices tanking?
Well, I think the tanking in the oil price is a consequence of coronavirus. So were it not for the coronavirus causing a collapse in global demand for oil, the oil price would have stayed at somewhat higher levels, and OPEC wouldn't have been having that meeting with Russia to cut back on production further. So we may not have seen this latest market share war amongst OPEC and Russia. I mean, the other argument, I guess, is that there was a real underlying issue. Markets had a 9-year bull market or whatever it is in the US since 2009. They were due a huge fall. It was all built on the quicksand of lower interest rates and leverage. I do think markets were vulnerable to a correction, because we'd had a big run up since the last greater than 5% fall, which was back in August. But I don't think markets have become irrational exuberant. We're in a world of very low interest rates. We had low interest rates not because central banks made them low, but because we've got a lack of inflation, lack of demand globally, and lots of spare capacity. And so it's quite rational for investors who are faced with a very low interest rate to think, oh, well, I can get 5 or 6% out of the Aussie share market, maybe I'll have it in there. And so I don't think we were seeing the sort of irrational exuberance that existed in the credit market going to the GFC, that is the US credit market particularly, or share markets to the same degree that we had going into the year 2000. Although you could argue there's a bit of irrational exuberance in the tech stocks, the FANG stocks, so to speak, but I don't think we saw the broad-based exuberance. And some people say, well, last year the US share market returned more than 25%. So did Australian shares, or a little bit less. But then again, just bear in mind they had a terrible year in 2018. So it swings and roundabouts on that one. It wasn't as if we had one boom year after another, like we saw in Australian shares going into the GFC.
Okay, you mentioned also earlier that the number of new cases in China have dropped off, which is good news. I think South Korea, there's been a similar story. Do you regard that as containment, and what does it take to get to containment?
Well, that's a good question. And if China can do it, then I thought, well, maybe other countries can. Then you sort of watch the Four Corners report, which showed people being locked in their houses. I didn't watch it. I was turning down the noise and watching Channel 10 or something. Or 7 or 9. I'll put an ad in for all of them. But my wife watched and she told me. But so you can sort of say, well, we can't do what they did in Hubei province. But the containment in the rest of China wasn't quite as radical. And if you look at the data, they seem to have managed to control it in the rest of China reasonably well as well. And then you could also look in one of those charts there, the bottom right one on slide 7, I think it is. Singapore and Hong Kong seem to have done a reasonably good job of containment this time around. And as the question there said, South Korea seems to have done a good job. So it does look as if containment is possible. And therefore, and it's not just a China Hubei province thing. So that also gives me a little bit of confidence that maybe if we keep pursuing down the path of containment, we may be successful on that front, and maybe Australia hopefully could be better at that than others.
Just coming to some last questions, possibly a theme that you can speak to is there's a lot of people asking what on earth is happening with the Australian share market jumping up and down. Not specific questions, but just a bit of a please explain. If you could speak to that a little bit.
I think that's just a reaction to what's going on elsewhere. In times like the present, it's very hard for investors to accurately price or price with any confidence what's going to happen. And so you can see that in the share markets, we're down one day 7-8%, and then the next day we might be up 4 or 5%. Sometimes it's a reaction to news from overseas, like the oil price falling on the weekend, or President Trump not delivering in terms of stimulus plans. But because investors just don't know how to price it, you get these wild swings. And we did see that at the time of the GFC. Investors didn't know how to price the threat posed by subprime debt and the exposure investors had to that around the world. And likewise, you're seeing something similar in relation to bond markets. The bond yields have come crashing down, and recently they've gone back up again in Australia and the US. We're seeing it in credit markets. We're also seeing it in the Australian dollar and the US dollar. Initially, through this crisis a few weeks ago, the US dollar was soaring. Then the US dollar collapsed below where it was before the crisis started, and now it's halfway back up again. So investors are just struggling to try and work out how to price these things. Likewise with oil and gold. Gold has mostly gone up. Last night it fell, despite big falls in share markets. And also commodity prices. On the one hand, you could argue, well, China's going to stimulate, good for commodity demand. On the other hand, well, maybe the rest of the world will be weak. That's bad. So it's just hard to get a firm handle on this, because it's sort of out of the realm of what most investors focus on. They're not epidemiologists. They haven't dealt with the virus on this scale before and the human reaction to it.
We're just about out of time, but I'm going to squeeze in one more question because it's an interesting one. A few about how long a shutdown would have to be if we're all put into isolation, similar to what's happened in Italy. Is it a matter of weeks or months? What does history tell us about that?
There's not a lot of studies on that. In China, it seemed to be, I think it was about a month or 6 weeks. And if you go back to 1918, I think there it lasted a month or so as well. In some cities in the US, I think there's data on that. But the shutdown is designed to sort of slow it down. And I'm a little less sure about Australia because we're coming into winter. That gives me a little bit of nervousness. But in the Northern Hemisphere, if all of Italy suddenly shuts down like they have, and they follow the rules, I don't know if Italians do that, but let's assume they follow the rules of the shutdown, then, sorry, you're not Italian, eh?
I am actually.
Well, sorry.
There we go.
There we go. Sorry.
Read the room wrong on that one.
Oh, God. Anyway. But anyway, sorry about that. But, you know, there's a good chance that it might nip it in the bud, so to speak, and slow it right down. And that's why these shutdowns can be effective. So on the one hand, it's horrible for economic activity and people who get caught out without toilet paper or whatever it is. But on the other hand, you know, within a month or so, it comes back out, and particularly in Italy, when they start to go into warmer weather, then fingers crossed, you know, hopefully the worst is over.
Well, who knows with Italians, Shane? The case, right? There you go.
No, they've given us lots of good things.
Of course they have. You redeemed yourself earlier with the Bachelor shout out anyway. We are out of time, everyone. Thank you so much for joining us today, and thank you, Shane, for all of your time and insight. Just a reminder that this recording will be available straight after, or shortly after, I should say, today's webinar, which includes the slides. I know there's been a lot of questions about that. Thanks again, everyone. Have a great weekend.
Thank you.